Shares of Uber are up 140% over the past year. This company's made a massive recovery from some pandemic lows when people were worried about the company's cash flow. I was one of those people that was worried that this was a company that had more than a decade history of just burning through cash and they were never going to get to free cash flow positive. But they have done that over the past year. Investors have been rewarded. And I think there's some really positive trends for Uber. But is the stock still a buy at the current price? I'm going to dig into all of this in this video. My name is Travis Hoium. Thanks for watching Asymmetric Investing. Please subscribe here on YouTube for all my content. And thanks to this video's sponsor, The Motley Fool. If you go to fool.com/ASYM, they'll give you their top 10 stocks to buy right now. So let's go with a couple of charts that I think tell the story of Uber really well. The first one that I want to start with is the company's revenue and free cash flow. And the crazy number is that the trailing 12-month revenue is up more than 3x in just the last 3 years. Now, these were some pandemic lows. People weren't traveling as much, so not taking rides. But this is really strong momentum on the revenue side. And you can see here with a competitor like Lyft, they just don't have the same scale that Uber has from a revenue perspective and aren't able to translate that to positive free cash flow. And this really gets to, I think, the really important thing for Uber from a strategic perspective. And one of the concepts that I like to think about is what's called the smiling curve. The smiling curve, it just puts context around where companies fit in value creation and their scale in the market. And I think the ride sharing market is a great example of a market where if you are the biggest company, the biggest ride sharing company in the world, you can create tremendous value because you have more scale than anybody else. That gives you the ability to attract more drivers, gives you more operating leverage on your technology, and potentially even gives you the ability to increase your take rate, something that Uber has done over the past year as well. And if you're one of these smaller companies that just doesn't have the same scale, so you're Lyft, DoorDash, Grubhub, any of the other ride sharing or delivery companies, it's just difficult to compete with a company like Uber that has much more scale. And Uber can take the scale that they have on the ride sharing side, move that to Uber Eats, transport all kinds of other goods. They are really just a technology company who's working with two sides of the market, the drivers and the people who are trying to move either themselves or goods around the world. So the company has leveraged that position from a scale perspective to then increase their cash flow. $3.4 billion worth of free cash flow over the past year. A couple of the metrics that I want to highlight that have really driven this. This is Uber's three market segments. The black column is mobility. So this is just typical ride sharing. That's what the company was built on. Blue is Uber Eats primarily, so delivery revenue. And then the orange is freight revenue. Freight is something that they've actually pulled back on over the last couple of years and really focused on their core markets of mobility and delivery. And that's what has driven the company's success. And one of the strange things about companies that operate in a business where scale like this matters is that they can actually charge more and take not only charge more for each ride, but also take a higher take rate than some of their competitors. I know this doesn't sound like it makes sense, but when you have a bigger network of drivers, you have more availability, people are willing to pay more for that convenience. If you're a driver and you're looking for regular work and to go just from ride to ride to ride and not have to sit waiting for rides to come to you, even if you're making less per ride, it makes more sense to be on Uber than it does on something like Lyft. And so this is where you start to see the scale in the market start to be really advantageous for a company like Uber. And the great thing long term is this isn't something that goes away overnight. Yes, there can be challenges, there can be changes in market share, but I think once you reach the kind of scale that a company like Uber does, there isn't a lot of opportunity for smaller competitors to knock you off. I don't think Lyft is going to become a bigger ride-sharing company than Uber is. They just don't have the ability and the scale to beat Uber. Uber would have a number of ways to respond if Lyft did try to grow aggressively by either pulling away drivers or giving discounts to riders to try to incentivize them to use that app. Same thing in the food market. That is effectively a commodity, and Uber can just simply do that more effectively than their smaller competitors. So a lot of advantages come to scale with Uber. The question is whether or not this stock is still a good buy at the current share price, because I think that's really where the challenge comes in. Thanks to our friends at The Motley Fool for sponsoring this video. Visit fool.com/ASYM for the top 10 stocks to buy right now. So Uber shares are currently trading for 4.5 times sales. The price to earnings multiple is 90 times. and the price to free cash flow is nearly 50. That's a pretty expensive multiple for any company, even a company that's in as powerful a market position as Uber is in. If we look out to the next 12 months, so this is based on analyst estimates for the next 12 months of operations, you get to a price to earnings multiple of 64, enterprise value to sales of 3.9, and price to free cash flow of 31. Again, really expensive multiples for a company like Uber. So I think that's really the hesitation is Uber going to be able to live up to these multiples? The company currently has a $163 billion market cap. Like I said, that free cash flow was $3.4 billion. That is not a lot of free cash flow for a company that's valued that highly. Could Uber get to the point where they're at a price to free cash flow of 10x? You can buy stocks on the market with a price to free cash flow of 10x. That would mean that Uber would have to get to $16 billion worth of cash flow. That is a really tall task for this business. And I think that's where you fundamentally run into a problem with Uber's valuation. It's too expensive for the business that we have today. Just because Uber is in a really, really strong position in the market doesn't mean it's still a buy at the current share price. And so this is a stock I would like to see pull back. If there is some sort of change in the economy or in the market, a lot of these growth stocks, a lot of the companies that have recovered a ton over the last year or two, I think are going to have an opportunity to pull back, and investors are going to be able to get in at a better price. Because when you're paying for this kind of growth in a market where, let's be honest, the growth rate of revenue has really leveled off over the last couple of years. We've come out of the pandemic, but people are using ride sharing probably as much as they're going to. We are not at the point where ride sharing is replacing owning a vehicle in most locations. We haven't seen the advancements in autonomous driving that I think a lot of us thought would have happened over the last decade. So there may be a cap on some of the growth that Uber is going to be able to have. And add on top of that, it's gotten all of the fees associated with things like ordering food online have just made it more difficult to be able to pay for those kinds of things. I know I have pulled back in the number of orders that I've made on places like Uber Eats because it just gets really expensive. Restaurants are now charging more because Uber takes a cut of what they're actually charging for their food. And then on top of that, you have to pay for delivery fees. So that's a challenge for Uber from a growth perspective, and investors are paying a ton for the stock. So this is one of these companies that I think is extremely well positioned from a strategic standpoint. We've seen tremendous momentum both on recovering revenue and beating their competitors, taking that number one spot in the top right corner of the smiling curve, improve that cash flow. That's a really positive sign for the company. And I think there's probably more momentum to be had there. But that doesn't mean it's always a great stock to buy because the price is just too high right now. Paying 50 times free cash flow is just very expensive for any stock. And so if that multiple comes down to something more reasonable, like 10, 15, maybe even 20 times free cash flow, that would be much more attractive for me as an investor. This is a stock I'm absolutely going to keep an eye on because I love the business. I love the strategic position that they're in. The CEO has done a phenomenal job turning around their operations, but I'm going to stay out of the stock because I don't like the value right now. But what do you think about Uber and Uber's position in the market? What do you think about the stock price? Leave your comments in the comment section below. Don't forget to subscribe to Asymmetric Investing. Thanks for watching, everybody. See you here next time.